This is a BC Eagle accounting video. Business 371 Intermediate Accounting, Chapter 5, Revenue Recognition, Construction Accounting, Revenue Recognized over a Period of Time. Here are the key points to remember. Revenue is recognized in proportion to costs incurred compared to total estimated project costs. That is, revenue is not recognized when the customer is billed. Revenue is recognized when costs are incurred and are recognized in proportion to those costs to the total estimated project costs. The second key point is that the construction in progress account contains two items: the construction costs to date as well as the gross profit to date. The third account that you will see is the billing of the customer. When a customer is billed, it creates two accounts, a receivable and a liability that is like deferred revenue. For balance sheet reporting, there will be two accounts. One, the accounts receivable, which represents the excess of billings over the cash payments to date. And secondly, there will be a net current asset when the construction in progress amount exceeds the billings in progress. When the reverse is true, when construction in progress is less than billings in progress, the balance sheet will show a net current liability. Now, let's take a look at an example that we did in class. In this example, we have the Stone Construction contract, or company that had a contract with a $75 million contract amount. The contract will run for the years 2015, 16, and 17 and should be finished by December 31, 2017. What we want to do is to make all the journal entries that are necessary for this particular construction contract and show how this contract will be reported on the company's December 31, 2016 balance sheet, which would be the second year of the contract. This particular example shows how we would account for a contract that did have an overall gain, but in the last year we will show a loss on this contract for a special adjustment. More on that later. Okay, so as you first start an account or one of these construction in progress accounts, make 3 T accounts. One for CIP, construction in progress, one for billings in progress, and one for the accounts receivable. The construction in progress will show costs to date plus gross profits to date. The billings in progress will accumulate how much the customer has been billed to date, and the accounts receivable will show the net of the amounts billed compared to the amounts that have been collected in cash. Now let's do the accounts for the first year. In 2015, the actual costs incurred were $15 million, and the principals believe that it's going to cost $35 million more to finish this project. So $15 million into the project plus $35 million more to finish means that the total contract construction costs would be estimated at $50 million. At $50 million, compared to the $75 million fixed contract price, that means that the principals believe that there will be a $25 million gross profit on this project. Now, if there are 15 of the $50 million done, 15/50ths, that means we would recognize 15/50ths of the gross profit, or $7.5 million in the first year. So what we would record in the construction in progress account would be an increase in the construction in progress for the costs, $15 million, and another increase in the construction in progress for the $7.5 million of profit. So these two together will equal $22.5 million as 12/31/15. For the next year, additional costs of $30 million were incurred, so that means that total costs accumulated to date would be 15 from last year plus 30 from this year, or $45 million. The principals now believe that it will cost $10 more million to complete the project, so the $45 million into the project plus $10 more million to complete means that they now believe this project will entail a $55 million cost. Now, that is matched against the $75 million contract price, so the new estimated gross profit is now $20 million. The percentage done would be 45 million over the 55 million, or 45 times 55, or divided by 55 times 20. The gross profit to date would be $16.36 million. Since $7.5 million were recognized last year, the new amount to be recognized in 2016 would be the $16.36 million to date, less the amount recognized in previous years, 7.5, or the revenue or gross profit recognized in 2016 would be $8.86 million. So let's take a look at the construction T account. The additional $30 million of construction costs would be added to the construction in progress account, and we would show the $8.86 million of additional gross profit. So the beginning balance plus 2016 costs plus the gross profit of $8.86 million would give a $61.36 million construction in progress at 12/31/16. Now, let's make the journal entries for the year 2016. The first item that we would record would be the construction cost actually incurred, and as you can see, they were $30 million. So we would increase the construction in progress account, debit at $30 million, and we would show a variety of credits for cash, accounts receivable, or accounts payable, and maybe some other overhead items that would total $30 million. Also, we would need to recognize revenue. So we already know that the gross profit increase for 2016 would be $8.86 million. That gross profit increase needs to go to the construction in progress account, so we will debit increase construction in progress $8.86 million. Now, how much revenue are we going to recognize? Well, revenue will be a forced amount. Here's how we do it. We know that the construction costs will be expensed as they are incurred, so we need to debit the construction costs for $30 million. This will be comparable to the cost of goods sold if this were a retailer. And then we would add to that the gross profit on this particular project, $8.86 million. So the total construction revenue that we would recognize, we back into it by saying that we add the costs plus the gross profit to date. That must be the revenue that we would have on this particular project. Another way to take a look at it is to look at the total bid amount, $75 million, and we are 45/55 done. And in previous years, we recognized 15/50 of that amount. And so if you would run the numbers on the total gross profit to date, less the gross profit recognized in a previous period, we would arrive at this same $38.86 million. The third journal entry that we would make would be for the amounts that would be billed. In this case, the billings were $25 million. So we would increase accounts receivable and credit, not revenue, but the unearned revenue of billings in progress, $25 million. Additionally, there were $23 million collected, so we would need to increase cash, debit cash $23 million, and reduce accounts receivable $23 million. So here's what we've done for 2016. We have a balance of construction in progress of $61.36 million. We now have a billings in process from the $25 million that we billed in 2015 and the $25 million that the company billed in 2016, a total of $50 million. And now we will have accounts receivable of 25 billed in 2015 less 25 million collected in 2015 gave a 12/31/15 balance of zero. In 2016, $25 million billed less $23 million collected would give us a balance of $2 million at the end of 2016. Now, how would we show this on the 12/31/16 balance sheet? First, we would show a net accounts receivable of $2 million. Secondly, we must net or subtract the amount that's in construction in progress compared to the amount that's in billing in progress. We have a debit of construction in progress, $61.36 million, compared to $50 million credit in the deferred revenue or billings in progress account. This will net to an $11.36 million costs in over billings to date, and that would be a net current asset. Some things to keep in mind. When the construction is completed, because we're showing cost to date and gross profit to date in the construction in progress account, the balance in this account will be the contract bid. It shows all the costs to date and all the gross profit to date. So when you are finished with the construction in progress is equal to the contract amount. Also, because you bill everything that your contract says you can, at the end of the contract, the billings in process also will equal the contract amount, in this case, $75 million. Another useful tool to have is a running or cumulative revenue account on the contract. Now, this will be a dummy account that's not really in the general ledger, but this is a tracking account just to show how much revenue has been recognized to date. So as you make journal entries for revenue for each of the years, this revenue account should also equal the total contract amount that the construction allows the contractor to bill. There you have it. This is construction accounting. Give the problem a shot. Thank you for listening.